Good morning and welcome to the Lotus
Conference call. All attendees are in a listen-only mode. If you would like to ask a question directly to the company, please use the raise hand function within Zoom. I'll now hand over to Lotus Chief Executive Officer, Greg Bitter. Thank you, Greg.
Thank you, Nathan, and good morning all. Appreciate you all joining. I'm joining this conference call from London, attending this year's WNA World Nuclear Fuels Symposium. And it's quite appropriate that it's on at the time that we make our first offtake and prepayment / unsecured loan announcement. As you will have seen from the announcement yesterday, Lotus has executed the first of several expected offtake arrangements for its strategy of securing fixed price, base price escalated offtakes with several parties for uranium, ideally for deliveries from 2026 through to 2029-30. And we're looking to secure these offtake arrangements to validate the project, to signal confidence around the restart plans and operations that Lotus has for its Kayelekera project, and to underpin the restart plans that we have. The announcement involved PSEG and nuclear and Curzon uranium. The Curzon uranium offtake involved a prepayment / unsecured loan of $15 million US, and that will be considered and potentially used as part of the overall funding package for the Kayelekera restart plans. As part of these arrangements, Curzon's binding agreement is to buy 700,000 pounds of uranium, and Curzon is also granted an option to buy an additional 100,000 pounds per annum for 2030 to 2032, so an additional up to 300,000 pounds per 300,000 pounds in total, should that option be exercised. That option can only be exercised and is subject to Lotus drawing upon the unsecured loan / prepayment facility. Lotus's term sheet, which is subject to formal documentation with PSEG, involves a similar structured arrangement, fixed base price escalation with an escalation factor involving 800,000 pounds for delivery across the same years, 2026 to 2029. Lotus will move into detailed documentation and finalisation of the PSEG offtake arrangement in the coming weeks, and we expect that to be finalised in short order as well. The unsecured loan aspect of the arrangement with Curzon is very important to us, as it demonstrates the ability to raise money in the form of a prepayment and unsecured loan, and that will come into the funding mix as we move towards the restart of Kayelekera. There is no obligation on Lotus to draw down that facility. There are no commitment fees or upfront establishment fees other than Lotus incurring the legal fees of Curzon, and it can be repaid at any time during the 12 months from utilisation, or indeed out to 18 months, subject to Lotus's intention to extend that. As part of this initial funding round, as part of this initial offtake round, Lotus is looking to achieve up to about 30% of forecast produced pounds 2026 to 2030 under offtake arrangements with the base price escalation mechanic. That would take it up to about 3.5 million pounds. These two represent 1.5 to 1.8. So we're looking to layer in and announce in due course additional contracts for that additional circa 2 million pounds. Beyond that, we will look to how the market performs as to how we progress towards the restart of Kayelekera, and then look to layer in additional tranching of offtake arrangements between now and production. With that context, it might be best to go to Q&A. Nathan.
Thanks, Greg. We've just had a couple of questions come through first, so I'll ask those. So your first question comes from Andrew Oswald at Bell Potter, and he's asked, how many more offtakes can we expect, covering what portion of the production and over what time frame?
Yep. Look, I think so. The strategy is several rounds or several tranches of offtake contracts. So this initial round is looking to get up to about that 30%. So there will be another several of these offtake arrangements. Certainly, I envisage at least 2 that will take us up to about 30% of our forecast production through until 2029, 2030. And then as we get closer to the restart, we will look to take that percentage higher, and such that very close to production, I envisage that the majority of our forecast production for certainly 4 or 5 years will be covered by a combination of base price escalated contracts and market priced or market linked contracts. Those contracts we're seeing with collar arrangements, so floor pricing and capped pricing, and those collar parameters are escalated based on the current market conditions and current market contracts. So I see a combination taking us through to the majority of our production as we get close to restarting Kayelekera.
Thank you. Your next question comes from Andrew Hines at Shaw and Partners. Please go ahead, Andrew.
Yeah. Hi, can you hear me fine?
Andrew, I can.
Yeah, great. Congratulations, Greg. Well done on getting your first contracts through. I note that the timing is 2026 through 2029. So 2026 not that far away now, Greg. What's your latest thinking about how quickly Kayelekera can get brought back into production? I presume you're still looking to hit a final investment decision later this year, which means there's a lot of work to do to get those other contracts in before the end of this year. And then are there ways to get Kayelekera into the market faster than you might have thought previously in terms of the construction timelines?
Yeah. So Andrew, look, as you rightly allude to, the DFS contemplated a circa 15-month production window. I think the work we're doing at the moment, both on the capital front and the schedule or timetable to production front, gives us the confidence and the view to think about production sooner. This is a restart, so the quicker we can mobilise and start to think about various aspects of the plant and turning on various aspects of the plant, the sooner we will be in production. Keep in mind, the 15 months involved everything being brought on as a package, including the new acid plant and, importantly, the electricity grid connectivity. Now, if you take those out of the critical path item, or take those off the critical path list, this plant can be restarted given the gensets and diesel power on site, and that was how it was powered under previous ownership. That's not the long-term proposition. Certainly want to optimise the cost structure and reduce the OPEX, but there is nothing to stop us turning the plant on with all of the other work involved undertaken before that grid connection occurs. So there's certainly ways of sequencing, and that would involve sequencing and shifting out some of the capital spend, and that would allow us to think more aggressively around the 15-month schedule to production.
Thanks, Greg.
Thank you. Your next question comes from James Bullen at Canaccord. Please go ahead, James.
Thanks, Nathan, and congratulations, guys. Just around pricing, I guess, is there much of a delta between the prices in the term sheet and also in your binding sales agreement with Curzon? And then how do we think about escalation? Is that a CPI style escalation, or is it just a fixed escalation per annum?
Yeah, James, so I'll take the escalation question first. Look, essentially it was a proxy for CPI and price increases, and that's how we started off thinking about the escalation factor to be used, CPI plus or minus. And then some of the counterparties have actually firmed that up in terms of a number. So if you, without being specific, if you think about the certain ranges out there for the CPI, whether it be the Reserve Bank or the Federal Reserve, and you think about it's X to Y%, yeah, that's the type of number that we're looking at, whether it's CPI plus or minus, or whether it's then whether it's been converted to a hard number for each year. Most often it's a consistent number across the years. Sometimes that number changes across the year, but that's the sort of parameter we've adopted. In terms of your Curzon question, was that related to the Curzon offtake and the Curzon prepayment or repayment mechanic under the unsecured loan?
Yeah, I'm just trying to understand what Curzon may be extracted out of you because they were providing a level of unsecured debt.
Well, actually, James, the Curzon fixed price or base price schedule or forward-looking curve in the offtake is no less favourable than any of the others. As a matter of fact, some of the years it's higher in terms of factoring in the chosen escalation factor. So I'd say none in terms of pricing.
That's great to hear. Thank you, Greg.
Thank you. Your next question comes from Colin McLennan at Petra Capital. Please go ahead, Colin.
Thanks, guys. Greg, I don't really understand the payment, the prepayment mechanics, if you like. So the offtake agreement, being able to offset up to £100,000, how that works? What is that? Just at market price? So I'm sort of used to it. It's going you can offset a dollar amount by delivering however many pounds. If you can sort of talk through how that might work. And then secondly, just the lender may receive payment through issue of shares, whether that's at their option, at your option, how that works. That would be great. Thank you.
Okay. So Colin, you can think about the repayment or offset as a dollar amount. It's just a dollar amount based on the pricing we've agreed under the Curzon offtake. So in the first year, the lender, Curzon, may elect for the delivery of those pounds, the value of those pounds under the offtake, so based on the agreed offtake pricing, to be offset against the loan amount.
Okay.
So it's literally, it matches the value of the value of what they're meant to pay us versus what we owe them.
Okay, super.
So it's actually quite simple that way. And you'll know that the without saying anything about the pricing, the £100,000 is obviously far short or far less than the principal amount, and that gives us flexibility around the first 12 months. Purely our option whether to extend the term to 18 months, and hence how we manage our liquidity and balance sheet through that period. And then the second question, Colin, related to the repayment share mechanic.
Yeah.
Yes. So look, in certain instances, the lender Curzon has the ability to provide Lotus with notice, and that's 30 days notice to repay or convert into. And if we don't make that, if we don't satisfy that repayment call, then they can convert into shares. And those events are really around, the main ones are an event of default. There's a key one if there's a material breach of the MDA that remains uncured or the breach hasn't been waived by the government. There's one that relates to the timing of production. So if we draw down and within a certain window, no ore or no concentrate has been produced. So they're really the types of triggers, and it's quite limited. There's a basket of probably 6 or 7 of them. Really event of default, or we don't do what we've said we'll do in terms of production plans. within the prescribed window, and we're very comfortable with the prescribed window. We're very comfortable that we've got the ability to cure certain breaches. But if we can't then repay the loan in 30 days, it gives them the ability to convert.
Okay, super. Thank you.
Thank you. Your next question comes from Regan Burrows at Bell Potter. Please go ahead.
Hi, Greg. Congratulations on the announcement. Just a couple of questions from me. Firstly, obviously, you mentioned electricity grid and asset plant could sort of be postponed. If that's your sort of thinking, I mean, that's roughly 36% of the capital cost. How do we think about that capital stack heading into sort of a final investment decision? And given you've got the 15 mil from Curzon you can tap onto, how are you sort of thinking that sort of all plays out?
Yeah, look, Regan, I think the best way is to start at the top of the capital stack, being the 88 million US of pre-production capital that the DFS talks about, plus or minus with any escalation. And you're right. So you take out the grid connection, which was a significant number. It was sort of 13. The connection purely itself was 13 million in the DFS. You stage the spend around the acid plant and the steam turbine, and look, that was a replacement acid plant. We've had engineers on site. The acid plant will be relocated with some use of the existing, or significant use of the existing infrastructure and acid plant components. And so that acid plant was 15 million US in the DFS. So if you assume a reasonable amount of that comes out and is post-construction startup, the camp refurbishment, for example, 3.5 million US, that was for fully refurbished 450 person camp. The way we're thinking about staffing, housing, local community involvement, jobs for the locals, etc., we believe that it's prudent to upgrade key aspects of the camp, and in the first instance 100 rooms, and so that will be halved. There's the ore sorting, given the ROM stockpiles that exist. Nice to have the ore sorter day one. We will have the infrastructure, the plumbing all set up such that it comes in and can be essentially plugged and played, but we don't need it on day one. That's $5 or $6 million. The 88 also included a contingency of about 9 million. So if you start to move some of these big ticket items out of that initial stack, recognizing they're all very critical, such that we optimize the operating expenses, and we want to do that very quickly. But we can do that during ramp up mode, post first ore being fed through the plant. So we're working on that now. You've obviously seen significant changes and additions to the technical team, and a lot of the work that they're doing now is focused on moving more quickly to production, and what is the optimal capital sequencing to do that. So look, we'll have more to say on that, Regan, in probably the next short while.
Great. And if I could just sneak one more in there, just in terms of the offtake, obviously you're quite confident that you're going to sign a few more contracts before the end of the year. Are you looking on market, off market? How sort of, I guess, what can you sort of convey to us that gives us confidence to know that you'll hit that target?
Yeah, look, I was actually surprised by PSEG being the first one, given the progress we've made across a number of potential counterparties. Pleasantly surprised. The others, again, for this initial phase, are all base price escalated. When you say off market, we have gone to each of these counterparties outside of their traditional RFP processes, and that really is on the back of the relationships that we've developed, principally here in North America. I'm in London at the moment, but in North America, and their willingness, each party's willingness to help support a new entrant for a new source, diversified supply. So we've essentially gone out looking to on an unsolicited basis engage around a small quantity of pounds per annum over 4 or 5 years, with flexibility around 2026. And certain other aspects that are quite bespoke in terms of how our board wanted to think about our risk mitigation. So very confident that there will be more to come. The additional ones will be very similar to what we've outlined in yesterday's announcement. And then as we move forward to the next tranche, depending on the market conditions, we'd like to start thinking about market-based pricing, but we'll see and assess the market at the time.
Great, thank you for that.
Thank you. There are no further questions at this time, so I'll now hand back to Greg for closing remarks.
Thank you all for joining. Thanks, Nathan.